All right, guys, this is going to be the NQ11-1-24 trade review and outlook. Trade review, reviewing a couple of trades that I took, put $500 into an account on Wednesday, and I flipped it to 34.40, or really I shouldn't say flip because I wasn't in the process of flipping account. I grew it to 34.40 over the span of about 4 trades, took 2 losses, 2 wins. Now, my outlook, this is going to be a running theme now with more understanding of how the markets run and just trading versus investing. I look at the markets now from a 1 to 3 month outlook. So really almost a quarter looking at the market view. So 3 months worth of data. And that's how I'm going to start framing up my macro bias. All right, so let's go ahead and get into it. So just from this chart alone, before we move over to trading view, I was trading on the NAS 100 CFDs rather than the futures this week. Like in the last video, I explained that in order for me to start trading futures again, I'm going to build my account up to about $300,000-$400,000 before I jump into trading futures for personal funds. Now, I still have my Top Step account, making payouts or whatever, but I don't like the limitations that it puts on me. Yes, it's making me more disciplined, but I also love the personal trading style where I don't have anyone telling me what I can and cannot do. I guess that's just something innate in me and a lot of other people that like trading personal funds. So for the time being, I'm going to leverage the CFD markets to take swing trades, which is another drawback of trading with a prop firm. Futures prop firm is they're more geared towards day trading. And yes, I can day trade, but I prefer, with the lifestyle that I have currently, swing trading. So I can catch a trade or frame up a trade on Monday and let it play out over however X many days until it reaches my target. Whereas I'm also in the meantime, in between time, I can frame up scalp trades for the day trading on Top Step. So I'm going to leverage both of those until I build a large capital base to put into a personal futures account, and then I'll go strictly futures. And then just, cash flow, make profits, withdraw, whatever. All right, so yeah, a little rant, but that's the framework that I have right now. So specifically for this particular trade, we are looking at the NAS 100 CFD chart. All right, so the broker that I'm using, unrelated, I'm using KOT4X for my CFD trades. And if I'm trading personal for futures, I'm looking at trades, or I'm trading with TradeStation, and then Top Step, I'm using Trade-Evade. All right, so my macro bias is bearish. The number of trades, profitable trades I've marked here on the chart is 2, and these were both intraday scalp trades. Well, the reason why is because they just happened so fast. They were actually meant to be swings, but they ended up being very, they ended up being the trades that they were. So, let's go ahead and get over to TradingView and show you the reason why I am bearish. And let's go ahead and zoom out. So if we're looking at this market, just zooming out here, we can see that this is clearly bullish overall from a yearly perspective. The NASDAQ is bullish. But when looking at it from a principle of range, meaning premium discount range, I see this as I'm trading right now in a range. We have not been trending past this high. We've been stuck between this high and this low. So because of that, I see this as trading inside of a range. And if I'm trading inside of a range, my principles are trade, sell. I want to short in premium, so shorting is selling, and I want to buy or long inside of discount. And as you can see, inside of the premium, this entire time, if you look at my previous videos, I've been looking strictly for sells. This is because I'm inside of the premium range. Now, if this was a trending market, obviously I'd be looking for buys. But because we're ranging, I'm sticking to my principles that I want to be shorting inside of the premium side of the range, and I want to be longing inside of the discount side of my trading range. So because of that, you'll see that in those previous videos, I was looking for sells. Yes, the buys were a little bit longer, but based off that principle, once again, reiterating, I'm shorting inside of the premium side of the range. But if you also want to look at it, framing up those swing trades versus intraday trades, inside of the premium side, if you just want to look at the anatomy of how these legs, which are these price runs here, look at the inside of the premium, look at the bearish or the bullish runs versus the bearish runs. These bearish runs are high volume, high momentum inside of the premium versus the bullish, and vice versa in the discounted side of the range. You can see that the bullish runs are high volume, high momentum. So that's the reason why I was looking for these particular trades, is because one, inside of the premium range, if I'm looking for sells, they're going to happen relatively quickly compared to the bullish runs here. So as you can see, like the bearish runs, they're like 1-2 candles and they cover a lot more they're displaced a lot higher, versus the bullish runs, they take a lot more candles and I'm in the trades longer. And one thing that I love about trading in this particular way is I can be in and out of trades really quickly at high volume. And if I'm swinging, I can catch a lot more points, or in this particular case, pips, just based off of the trading range principles. So that's a little background of why I trade the way I do when it comes to trading ranges. Obviously, if I'm trading with the trend when the price is not ranging, I'm going to take those trending moves. All right, so that's the reason why I'm bearish. So now let's go ahead and get into the trades. Firstly, I did catch a trade up here once price mitigated something, wherever the heck it mitigated up here, and I wish I would have held it, because obviously that's almost a 1,000 pip swing, but whatever. Or that might be actually 10,000 pips. Anyway, yeah, so all right, so let's get into it. So this whole run here from the bearish sense took out this liquidity point, or this swing point here. At first it took out this point here and this point here. So because it took out two major points of structure on the 4-hour time frame, which is where I frame up all of my structure, I am convinced that price is bearish at this time. I'm convinced. If it transitions to bullish and like we still continue higher, whatever. But right now, what I'm seeing on the charts is bearish price action. All right, so we took out this low here, and I took a initial trade expecting price to continue to go to this low because the momentum was so high. And I ended up taking a trade off of a 15-minute sponsor candle or something inside of this wick that I'm notating here with the vertical bar. And that ultimately ended up failing. I was framing this up as a swing trade, but I wasn't at the charts at the time that price dropped down here and gave unwillingness to take out this low. And ultimately, I ended up breaking even on this trade because I did move my stop loss to break even, or my initial position. All right, and so that led way to these two trades. And then, the other thing is, my second losing trade was just initial, like, okay, well, probably didn't take out the stop loss, so let me just take another position, and did losing that trade. So I was like, well, that's on me. So the next couple trades, based off of this zooming out again, was looking at it from, okay, if price is going to move higher, but bearish price action is still intact and bearish momentum is still intact, I need to look at three things in order to frame up my trade idea in lieu of a bearish market or bearish sentiment or bearish bias, right? So the first thing is understanding order flow. Order flow is, to me, ensuring or annotating what makes this market or this price leg efficient or inefficient, right? So the first thing that I notice here is that we're pretty efficient from this price run here, bullish, all the way down to the low. Now, I say this because if we look here, all of this price action was very bullish, and then we had bearish movement. So everything here, all the trades, all of the money here is accounted for. So anything that happened inside of this range is already taken care of. So if we move past this point here, we're going to move higher. There's nothing here stopping this price run because everything is balanced. All the traders are in this side of the range are satisfied, and this area are satisfied. So now, because of that, I'm now looking below this line for inefficient order flow. And the first thing that stands out to me, based off of how we look at trades, is this wick here mitigated this wick. So now I'm automatically looking at this wick as my point of interest, or I'll start rolling out some more terms on how I define the risk range, what I told you guys I was going to come up with, or I'm coming up with here later on. But this is my first point of interest, post efficient order flow. So now we're looking at inefficient order flow. And this is my first point of interest. And now the next point of interest I'm looking at is this inefficient pricing here. Okay. So these are my 2 4-hour or macro points of interest. And now what I want to do is define my risk range by refining, going down to those lower time frames and seeing, hey, is order flow efficient inside of this point of interest? And if it is, I can invalidate that point of interest because price is already mitigated, everything in there, everything is balanced, everything is efficient. And then I want to do the same thing for my second point of interest. Obviously, we're looking at this in hindsight, but I'm showing you the process of how I framed up this trade idea, the logic that I employed in order to catch this trade. All right, so next thing I do is I go down to the 15-minute time frame and I look at the top down. Always when you're looking at, if you're marking up more than one point of interest, you want to start with the farthest away point of interest and then move to the closer one, right? Because you want to, if you think about it in the framework of premium and discount, you want to get the most out of the trade. So obviously the one that's lower is not going to give you the most out of the trade. So you want to look at the one that's higher, in this particular case for shorts, and find ways to invalidate it if it can be. And if not, then that's your point of interest. That's the area that price is most likely going to be drawn to, right? And that's something that I've had to learn over time, why I would catch trades and then ultimately price would shoot up past that point of interest and it'll go into the real point of interest and then give the full move, right? So this is a way or a process to capture that invalidation or ensure that I'm choosing the correct point of interest based off of finding inefficient or efficient order flow. All right, so now what we want to do, same thing, order flow logic. What stands out to me, this here is a bullish price run and it's balanced by this bearish price run. So automatically this is invalidated. And I say this is invalidated is because all the order flow is efficient here. Everything is accounted for up until that point there, up until that point here. So now because of that, what I see is we're now into this point of interest. Now this is where I'm going to show you a little bit more about why I define risk ranges the way I do. So building off of the framework of inefficient pricing from RCV concepts, I see we mark up here 15 or the open and 50% of my inefficient pricing is usually the area that I look for based off of the RCV concepts. But I'm extending this a little bit more in order to capture this area from the open of this wick to the close of this body of this candle here as additional, I don't know how to say it, but an additional area to encapsulate risk, right? So specifically for shorts, anything inside of this inefficient pricing from 50% to low is invalidated. I don't care about it. So now what I'm doing here is I'm taking this green box and saying, hey, 50%, or actually, shoot, from 50% of my inefficient pricing marked between the two wicks to the close of this inefficient pricing is now my new, is my risk range, essentially. So now this is the area that I want to look in and refine for a trade idea. So now I know that, hey, if I wanted to, if I can't find anything on the lower time frames for a potential trade setup, I know that if I want to take this for a swing off the 4-hour, this is my entire risk that I would be looking for. So usually I would enter it, at 50% in this particular case based off inefficient pricing rules, and my stop loss would be above here. But now I want to start looking inside of this area more often, defining that risk range and refining it to frame up a precise trade idea. So now that we've done that, we now want to go back down to the 15-minute time frame and we look here. So automatically, remember, We just went over the process. We actually went forward, too far forward, in establishing this order flow here is efficient. So my risk range honestly is now from here, from the efficient order flow to 50% of the inefficient pricing. So now, because of that, I'm looking in this area for trade ideas. 15-minute, nothing's clear, just open price. So we need a little bit more resolution, a little bit more data. So now we go down to the 1 minute. Once I go down to the 1 minute time frame, first thing I see, so cool about this, is we get consolidation. This is a buildup of liquidity. And as we build up a liquidity, we're coiling up in the market for a price run. This, to me, indicates that something sparked this bearish move. And when I say this bearish move, I mean all of this price action to the low side here. So if we're going to continue bearish price action, price would need, this is now an inefficient market from this area below the 50% of this risk range here. I need to see price move back in towards this consolidation and mitigate something inside of here that actually sparked the bearish price action of this move. So analyzing this chart, first thing that stands out to me, once again, I see this sponsored candle engulfed. Then I see another candle that mitigated this sponsored candle here, and that would be this green candle here. And this is now my framework for the trade. I've identified inside of my risk range the candle, the sponsored candle in this case, that mitigated a previous sponsored candle, was engulfed, and price tried to come back up to mitigate the open, which is left unmitigated. So price is left inefficient here. And then price ran away from this. So if everything that I just said flows, this is the candle that price is going to mitigate. So caveating this with how I took this particular trade was based off of actually this wick here. Now, the reason is because when I'm trading CFDs, there's something called spread. So there is a little bit of buffer or displacement between the buy and ask prices for this particular contract, or how contracts for difference work. So I've been burned in the past for trading these types of things. So I actually ended up taking my trade from about 160 and had my stop loss at about here, which is about a 260 pip stop loss, which is totally fine with me. But if I was on futures, I definitely would have taken it based off of the sponsored candle here. But because I've been burned time and time again from CFDs, either not being in the trade or being stopped out because my stop loss is too tight because of spread, just based off of those types of brokers and how price differences happen, I just went ahead and entered a little bit lower than what was supposed to happen. All right, so that's the reason why I took my trade here. If you see an RCV, my chart was showing, or my position was showing 160, and my stop loss was up here when the position I'm showing here is actually there. All right, so yeah, frame that up. That's my trade. And so from the 1 minute, I didn't go any lower. Looked at this and I said, hey, price is going to come here, and then I'm looking for the trade. All right, so moving over to current price action, getting rid of my risk range. My position here was at the first black line. You can see that the sponsored candle was mitigated here. And so I went into a little bit more drawdown than expected, a little bit more drawdown, but that was encapsulated inside of this risk range. It's fine. I'm cool with it. And then you can see price went a little bit higher into that sponsored candle and ultimately did not go up towards, not even close to, the stop loss, and ultimately ran lower. Easy trade. And so my target, actually, I think I exited at 2066, and this was a $1,200 trade. All right, then my second trade was a simple continuation. So I honestly was done for the day, but it just, I was just on the markets and it just popped up and I was like, I have to take this trade. So what I saw was a simple continuation off of the 1 minute trade. So a simple scalp. I saw this sponsored candle, mitigated liquidity. And what I mean by mitigated liquidity, it took out this previous high here and ultimately got engulfed. And you can see there's inefficient pricing here based off of this candle and price action to the low. Now, why do I say that this is inefficient pricing versus seeing, hey, what you just said that there's bullish run here and then a bearish run there. So wouldn't that make that efficient? Kind of. But if you have to look at it from this standpoint of there was something that happened here inside of this wick that mitigated liquidity to the high side. So this, even though this right here may be efficient pricing, right here just above this wick, this is inefficient pricing. And as you can see, this wick here tried to come up and mitigate that, but it failed. And so ultimately, there is inefficient pricing on the seconds time frame, but how I took the trade was based off of the 1 minute and the 1 minute candle here, and I go ahead and capture all of that by identifying my risk range as this 1 minute sponsored candle, but knowing that, hey, price is probably going to come up here. But once again, because I'm trading CFDs, I want to use the entire candle in this particular case. If I was on futures, you would have seen me with that very wicky entry right here at the wick here. And I'll go down to the seconds time frame in a second to show that. But ultimately, I took this trade. It did scare me a little because it went up so high. And I was like, oh, shoot, if this is CFDs, this is probably going to tap my stop. So I actually had my stop loss just a little bit higher than what it was, just based off of the difference in spread, like I said. And ultimately, my target for this trade was the previous low. And this trade happened in about 15 to 20 minutes, which I was not expecting. I was honestly looking to hold this as the swing, the continuation, but it happened so fast that, hey, I was like, oh, okay, cool. This ended up being the trade. So if you're interested in the risk to reward on this particular trade or particular trades, this one was a, what was it? I had it at 29.7. Yeah, so this was about a 4 or 5 to 1. Usually, if I'm on futures, this would have been a lot higher. So if I was taking it from the futures perspective, because there's no spread, I would have had my stop loss there or my entry there and my stop loss there. So this would have been about a 100 to 1 trade from the futures perspective, which is not uncommon for the types of trades that I take. And then if we were looking at this particular trade from the first position, I would have taken it from there. And then my stop loss would have been here. And I said my target was here. And that would have been about an 8 or 9 to 1, which is, once again, not uncommon for the types of trades that I've taken. All right. So now looking back into this particular area, the reason why I said that's inefficient pricing, we'll look here now, go down to the 45 second. As you can see, this candle won on the 45 second. You can see it mitigated this particular wick here, and then price drove lower, engulfed it easily, showing that there's something that happened inside that candle. But as we go lower into the time frames, 30 second, a little bit more resolution, 15 second, as you can see, we're getting closer, but this candle's not engulfed, so I'm not really caring about it. 10 second, 5 second, and ultimately the 1 second time frame. And if I was able to go actually any lower, what you would see is that, or if I could get 3 second time frame or whatever, this would show that this is actually one candle, and that sparked this move. This 1, 2, 3 candles mitigated this price action here, or these candles here, this liquidity there on the 1 second time frame, and sparked this lower. So ultimately price came up to mitigate this. Really, I would say it's probably a 2 second or 3 second candle, but I can't get that time frame. And ended up mitigating that and drove lower. All right. So a very long video, jam-packed. Watch it over and over and over again. I dropped a lot of information about how I trade, how I see the markets in this particular video. And yeah, so reviewing summary, I look at 1 to 3 month outlook now for my trade setups. And so that's just giving me a defined range of data on how I view the market. If I'm looking in a trading range, I'm shorting in premium and I'm longing in discount. In this particular case on NASDAQ, I'm looking for shorts, right? Because we're premium inside, we're inside the premium side of this range. All right. Once we get into the discounted side, that's when I'll start looking for buys. because we're in the discount side of the range. And once again, just making sure that you're understanding order flow, what's efficient pricing, what's inefficient pricing, and applying candlestick logic, or just applying logic to the trades. Like, does this actually look mitigated? Is this mitigated? And I gave you a little bit more insight into the risk range concept that I'm coming up with. But yeah, I hope you learned a lot. See you guys in the next one. Peace.